Welcome everyone to the microstructure exchange. Today we have Andrei Kirilenko from Cambridge is here to talk to us about ETF pricing and mispricing. And Andrei has asked that we take a couple of question breaks after around 15 and 30 minutes. And if you can hold your questions until then, or you can also put them in the chat, then we do it like that. And then, as usual, we'll have a Q&A afterwards. All right. So, Andrei, the screen is yours.
Thank you so very much. Great opportunity. Really appreciate the opportunity to present it. This is joint work with Wladimir, Kraus, Linton, and Mingmei, Xiao. Wladimir is an economist at the Financial Conduct Authority. He is great understanding about the structure of the quite complex data that we're going to be looking at today. Oliver is an econometrician, very highly regarded econometrician. We need to make sure that the econometrics here, which are also going to be quite complex, is on par. Mingmei is my and Oliver's PhD student, and she and I have worked throughout this, in particular on the modeling and setting things up in terms of going from the modeling to the estimation, and working was really amazing data. Some of this you've never seen before. So the growth of ETFs, let me try to make sure that we define terms. To those of you who may have heard this term, you probably heard it in the context of it becoming a very, very important asset within the asset class. It is a fund. It is an actual fund that holds a basket of assets and trades on stock exchanges like a single stock. So the assets could be other stocks, they could be bonds, they could be commodity futures, they could be commodities themselves. And as you can see, this time series, this chart ends in 2022, but the growth continues. In my opinion, this is probably the most important innovation in the security space over the last 35 years. It's really taken off really quite massively. About 14,000 of these listed globally according to Bloomberg as of August 2025. Assets under management about over 15 trillion by some estimates, which represent about 15% of total global AUM. They're popular with both retail and institutional investors. And the way that they are designed, in that there is an ETF security which has its own price, which trades as its own security on an exchange. And then there is a net asset value of the underlying basket, which is the weights of the underlying basket times the prices of the underlying assets, which is typically calculated at the end of the day. So ETF trades throughout the day. At the end of each day, there is an ETF price and net asset value of the basket. We're going to use the term ETF mispricing as the difference between ETF price and net asset value. This is not our term. This is a term that started being used, sort of thrown around after the global financial crisis. There's some papers came out, and you can call it premium discount, you can call it differences, you can call it mispricing. The main idea in some of the papers that came out is that these differences arise not as a result of staleness or calculation issues, but as a result of some finance, some actual financial economics, not as a result of just mismeasurement of the underlying parts. So mispricing in this sense is something that arises out of activity as opposed to measurement issue. So to give you an example, to give you sort of a picture of what it looks like, this is the in percent price minus NAV divided by price of a particular ETF. So this is a very liquid ETF with broad exposure to 23 developed countries. It is a mature ETF. It's been around for a long time. It is a large in terms of asset management ETF. So, we can see that in percentage terms, this mispricing, price minus NAV, scaled for presentational purposes. This is just for illustrative purposes. We are not going to, this is just to illustrate to you what this time series looks like for one very, very liquid ETF. It looks like this. And the shaded part in the middle represents COVID time. So the way you look at it, if you just look at it in terms of a statistical time series, here's what I will see. I would see that this particular process, statistical process, has mean zero, fluctuates around zero. It has memory, meaning if it stays high, if it's high, it stays high. If it's low, it stays low. And it has jumps, and jumps go in both directions. So this is the process that we're going to try to figure out. What gives rise to this? And these differences could be quite large. I mean, they could be 5%, 1.5%. So this is not 10 basis points where it just sort of bops around zero and so on. Yeah, so this is sort of to keep in mind sort of what this is. So mean zero, you can kind of imagine that what gives it, what brings it to zero is probably some sort of arbitrage activity. Memory is something that this arbitrage activity presumably is not instantaneous and probably takes over a period of time, perhaps, to deal with it. And jumps, again, in both directions, represent probably something else, some sort of shocks that come up. And maybe these are liquidity shocks, maybe these are informational shocks, and COVID is probably informational shocks, probably other shocks are there. And these shocks are kind of mean revert, but they kind of stick around. So this is the process that we're going to try to get a handle of. So what drives mispricing? And I'm going to tell you a story that we think is what's going on. So these ETF shares are created and destroyed very specifically in response to market demand. So ETFs are interesting as a type of asset in that we know assets that are in positive net supply, stocks and bonds that stay in kind of positive fixed net supply for a period of time unless there is a additional issuance or buyback. We know assets that are in zero net supply, such as futures. For every buyer, there is a seller, and in net supply, there is zero. This asset is a variable net supply. The supply of this asset actually varies from day to day. There could be more of this asset or less of this asset. It's still positive. It's a stock-like, but unlike a stock, the supply fluctuates in response to demand. More demand comes for this asset. There is a way to create more of it. So how is more of it created? So changes in this market demand for ETF shares are intermediated by very particular type of intermediaries, and they're called authorized participants. So they are both market makers in the ETF market, and they also have something very specific that they're authorized to do. They're authorized to create or redeem ETF shares in exchange for the underlying basket. So they could get the basket of the underlying, or actually create a redeem basket. They're not exact, actually. Present it to the sponsor of the ETF. And when you think of sponsor, you think of BlackRock, for example. That's the one who sponsors the ETF, but not responsible in the day, sort of today, to making markets in it. That's what authorized participants do. And they could also go to the sponsor, present the underlying, and receive the ETF shares. Notice that there is no price involved. They present the basket and they receive the ETF. If you present the basket, you receive the ETF, sort of irrespective of what the prices are. That's what they're authorized to do. They're authorized to increase or decrease the supply of the shares in response to demand. So the supply is variable. Why do authorized participants do this? Because they arbitrage between the two markets. They're able to arbitrage between the two markets. A typical market maker, in order to arbitrage, has a bid-ask spread, holds inventory, but that's about it. They're in this secondary market doing whatever they're doing. Whereas in authorized participants has access to the actual creation and redemption of the original share. So what they do is when they run this arbitrage, they manage their inventory. Holding this inventory is costly to them. It's costly because when they sit on this inventory, price can move against them, and it could affect the valuation and that translate into their P&L. So they don't hold too much of it, but they hold some of it. And if demand suddenly changes, they may get stuck with a lot of this inventory. And then they have to feed this inventory into the market as they manage it and adjust the prices. Remember, because they're market makers, they adjust the prices of the ETF. That way, mispricing can appear and it can persist. So we have arbitrage that gives us this fluctuation around zero. We have the mispricing that appears as a feature, not a bug. It is a feature. So what we are going to show you in the context of modeling this and presenting it, it is part of the design of this very interesting type of security that has variable supply of it. So our main contributions are we developed a model, both a static model and a dynamic model. We'll show you how to price this. We actually do not have a model of ETF asset pricing. We know they exist. And from sort of very pure sort of perspective, this is a redundant asset that shouldn't even exist in the first place. So we have a way to price these. And we have very, very unique regulatory data coming from the UK FCA on a large cross-section of ETFs, trade-by-trade data with IDs of those who traded, in particular AP IDs. And we have data on both their positions in the secondary market, what they've done, and also what they've created and redeemed AP by AP against the sponsor. So that's the plan. of what we want to do. Of course, we are not in a vacuum here. We're contributing to a literature. The literature is relatively recent, not super recent, but relatively recent. So it's perhaps because of the growth of this asset class, perhaps because of the way it sort of behaved during the global financial crisis. Also, there was an episode during COVID where Federal Reserve Board came out and they said that they would provide backstop for ETFs. So they were considered to be systemically important enough for the Federal Reserve to say we are actually going to we are going to introduce ourselves as an intermediary into this market if needed, which was needed, and they participated and they pulled out. So perhaps as a result of these, of this literature has developed. The literature has developed on inventory management and mispricing. So a lot of the literature is on ETF versus the underlying. In our paper, we will say we will leave the underlying to those who wish to talk about it. Because if ETF is a price discovery vehicle, then you will have information flow in from your price discovery vehicle into your underlying as a result of shocks, that liquidity and information shocks just from this market and correlations with other assets. People have done that. There is also work about something very specific, institutional structure, about how net asset value may be a particular way to represent sort of price, but it has staleness to it because of calculations for different asset classes. It responds with a delay, and as a result, some of the empirical irregularities appear. There's work on that. There is descriptive work on ETFs in times of stress. There's obviously work on the limits to arbitrage, it will be sort of in the back of our minds as we are developing our model. So we are contributing modeling. We're taking this model, translating this model into a structural specification, and we're going to take the structural specification to data for inference using data that no one has ever seen before. I will pause here and answer whatever questions there might be.
Okay, thanks, Andrei. We have a question from Anant Madhavan. Anant, do you want to ask your question in voice?
First of all, thank you for joining in. I'm so glad. And it's been too long since we talked, so thank you.
My great pleasure to join, Andrei. There's no way I'd miss your presentation. It's a fascinating paper. And just by the way, for the record, for everybody listening, for the 70 plus people, I'm no longer with BlackRock. I retired a little less than a year ago. So after 21 happy years there.
So can you talk? Can you talk now?
Yes, I can absolutely talk. So I have no constraints whatsoever. All right. So the question I had was, you characterized the price NAV deviation as mispricing, but I'd actually argue that there's a third value, an unobserved intrinsic value, and NAV might be the same as that intrinsic value. In the case of S&P 500 intraday, that's pretty clear. But in the case of an international fund, a bond fund, the NAV can be kind of different from the intrinsic value. And so the arbitrage that I guess I would see in my seat as head of research for ETFs and index investment at BlackRock for the last 8 years would be that the arbitrage is around price versus unobserved intrinsic value versus NAV, which is I think where we want to focus. And so my question actually, Andrei, is, when you see this big mispricing and you put up this chart with our UCITS fund, do you see arbitrageurs, hedge funds, and others actually trying to trade on this gap? Because otherwise, it's not actionable. So that was my question.
Right. So I am with you, and as you can see for everyone, Madhavan's name is up and down the slide. So he knows what there is to know, and my interest in this goes back a long time. I remember I had a conversation in San Francisco where I was asking him, like, what are these things? What's the secret sauce? So still interested, and now finally have the way to do it. So the way we're going to think about it is not dissimilar to the way you think about it. And that is the way I think about it is that there is the fundamental intrinsic value, and both the price, ETF price, and the NAV are projections of that intrinsic value. So these projections could be, it could well be that the projection of the intrinsic value onto the NAV is so good that they're approximately the same, or it could well be that the projection of the intrinsic value on the NAV is delayed in such a way that they're quite different. And similarly for the price. So this intrinsic fundamental value is never observed. It's a latent variable, but now we have two projections moving. And from these two projections, the way they're going to move in response to each other, and what will connect them would be inventory of authorized participants, the way they make decisions. It's 100% actionable. It's 100% actionable, and we can actually see it in inventory management decisions. So that's kind of the thought behind it. Does that make sense?
Absolutely. And thank you very much for that very clear answer, and hope to see you in San Francisco again very soon.
I would hope so, yeah.
Okay, we have a question from PK Jain.
Yep.
Yeah, thank you. So my question is about this microstructure noise. So like the difference between high and low prices every day is almost twice that of the close to close midpoint changes. So can the funds flow create the temporary pressure? I mean, is that the reason you think which will create the deviation between the two assets? Because they're independent markets, right? Trading, the underlying is a different market, and the fund flow might be focused on the ETF instead of all of the individual stocks. And then later on, that will create arbitrage. But I'm trying to understand the source of these deviations. Thank you.
That's right. So these are sort of different markets, and especially the differences in markets would be particularly, meaning the ETF and the underlying. And the differences in these will be particularly prevalent, observable, and sort of sensible in the case when the ETF is liquid, but the underlying is illiquid. So let's say you have corporate bonds, and these are junk bonds, and then you have an ETF on top of them. So these bonds are traded relatively infrequently, whereas the ETF is traded a lot. It's actually added to many portfolios. Many investors go in and out of it. And so in this case, you have and people have done research on it. You sort of have a price discovery vehicle, which is the ETF that feeds information and liquidity shocks into the underlying as they trade infrequently. You can also have a situation where you have S&P 500, so you can have or Dow Jones. You have the underlying assets are actually they're equities themselves. They're large equities. They're well traded. They're well known. They're well followed. And so there you do have different markets, but that difference between them is going to be very, very fleeting. And actually finding it it will be there because they're hit by different, especially liquidity shocks. Or balancing shocks, but it's going to be probably much less present. So 100% there. So we will be doing actually work. We will need to do work to make sure that it sort of hangs together. You can't just go into it, fly by night and assume that these are just price series. You all know who worked with this kind of data that you have to be very, very careful about the data generating process, understand it. I could tell you that work on this data generating process has been going on for a long time. And we have one of the co-authors that's his job at the FCA, to understand everything that there is to know about where these prices are actually coming from and what's behind them. So we take this 100% very seriously.
Thank you.
Continue.
Okay, we have one more
question.
and then we'll continue. Christopher, go ahead.
Yeah. Hi, I have one question about how you're thinking about arbitrage, because it is true that in the primary market, you could have the APs that arbitrage, but that would usually happen, I think, if there's a more significant mispricing, because they have to put their orders in by the end of the day to actually swap the shares, either create or redeem them. But many people during the day could also arbitrage by using the ETF and the underlying shares in the secondary market. So when you're talking about arbitrage, are you specifically talking about the primary market arbitrage?
I'm talking about all sorts of activities that bring these price and NAV in some Linton together. So it is both between the primary and the secondary market. It is also between the two secondary markets. It is across ETFs that are in some way correlated. These are to me are kind of forces, because I can't really see them directly, and there is some evidence that these forces exist. What I can see directly is the series and the activity of particular APs. So by arbitrage, I mean, loosely speaking, trading activity of, in this particular case, authorized participants. Some of their legs we see, some of their legs, in some of the parts of their trades we do not see. They're also different, they're quite heterogeneous, as I'll show you if I have time. So arbitrage in this case is trading activity that presumably they're engaged in to make money, because they don't work for the government.
Okay, all right, thank you.
Excellent. So we can go ahead. Yeah.
Okay, so what do authorized participants do? Is, as we just discussed, they are built into the actual design of this security. They're not external to it, like market makers. Market makers are, especially to the extent that they're not designated anyway, are actually external to the issuer, both primary and secondary. Authorized participants are directly cooked into the design of this particular security. And they, as you can see by these shares, by these arrows, they interact with the ETF sponsors through creation and redemption. They act as market makers, and that is, they trade in the secondary market. They participate in the market from the underlying securities, and they manage their inventory. So they do a lot of things. So in addition to being market makers, they also have interactions. Let's just call it as a primary market, market for the actual amount of this asset out there. So how do they do it? Let me show you something that we've probably never seen before. So what this is that one particular authorized participant in one ETF that I showed you before. This is for illustrative purposes only. And what you see here is the cumulative net inventory of this particular authorized participant and this particular ETF daily. And what the red line is the net inventory. The green line is the primary market position, meaning that every day they created something and redeemed something, and we subtract creation from redemption, and that would be their primary market position. They also buy and sell in the secondary market, and that would be their secondary market position. This is counting beans. This is in number of shares. This is all in ETF shares, so there's nothing underlying here. ETF shares created redeemed, ETF shares traded, right? So as you can see, the way you can think about it is that this particular authorized participant goes, presents underlying shares to the sponsor, at least buys or goes long the ETF shares that are being created, turns around and sells them on the secondary. So, and it's cumulative, it's as a fan chart. If they do one of these every day, so there would be, in the cumulative sense, there will be one per day one, and the next day they do one, but we will count it as two. The next day they do another one, but we'll count it as three. So we're just going to accumulate this, right? So you can see it as a typical fan chart. You can see that this net inventory position, primary minus secondary, was drifting towards a negative territory. Then something happened. Then they started drifting towards a positive territory. This is something, again, no one has seen this data before. You're seeing it for the first time. This is what they do. They're not all the same, but this is a picture that you may want to have in mind. This, to me, would be a classical authorized participant. Creates shares, sells them, makes money, goes home. So let's start with our model. How do we want to model it? And we're going to present it first with a static model. So in this model, there will be one ETF, and there will be one ETF share to invest in one share of the underlying, one for one, right? To make things very simple. There will be one AP under perfect competition who acts as a liquidity provider. This AP has zero inventory in the beginning and goes to ETF and the underlying. And there will be one uninformed ETF investor whose exogenous demand of X shares. So this, in the beginning of the period zero, you have the ETF price equals to NAV equal to P0. You can think of it as a fundamental or intrinsic price. So they are exactly on top of each other. In period one, the liquidity trader comes in and says, I want to buy X shares. Authorized participant sells X shares to the investor at the price PE that will result in zero profits under our assumption. The authorized participant then will choose a proportion gamma of this X to satisfy by keeping an inventory, and the remaining demand by creating ETF shares. So this gamma, as you can see, could be between 0 and 1. So this demand could be entirely satisfied by creating the shares out of the underlying and satisfying the demand of the ETF market, or staying in the ETF market. So the way it's going to hold additional assumptions, we will say that inventory holding costs are going to be, which are AP specific, are going to be lambda, which is going to be specific to each AP, is going to be multiplicative in the volatility of X, because the more volatile X is, the more biting this cost is to them. It's going to be quadratic also in gamma X squared, which is what they are actually holding. Price impact cost is ETF specific, and it's going to be linear in X. Price impact is the impact they're going to make by going into the underlying, buying the underlying, and then moving the price of the underlying as a result. M, again, is going to be ETF specific. The more liquid the underlying is, the higher M is. The more liquid it is, the lower it is. Buying the underlying is going to move the price from P0, the intrinsic value, to whatever was bought to be exchanged for ETF shares. So we have a problem of the authorized participant. The authorized participant is going to be setting the price, PE, in such a way as to satisfy this demand, partly out of inventory, partly by going into the secondary market and through the creation process. I'm going to assume that this authorized participant is fully competitive. That should allow us to set this to zero, this total payout. And they're going to choose gamma star to offer the minimum price. They're competitive in this market. So what we're going to get as a result of this, we're going to have the gamma star as a function of parameter values. And then, as you can see, we're going to have PE, which is a function of X. So it's multiplicative in X. So that stuff in there is, it's going to move price away depending on the size of X. We have NAV as a function of X. Again, X moves it away from P0. And then we have the difference between PE and NAV, which is again a function of X. I'm going to show you a picture of what it looks like. So this is a picture. So this is symmetric. X could be positive, X could be negative. X comes in anticipation of this X coming in. The authorized participant is going to set the price, E, in anticipation of that. And and the NAV is going to move because some of that satisfaction of that X is going to bleed into the market for the underlying and move the underlying. So as you can see here, it's like a double bid-ask spread. So you have the bid-ask spread that is set by the authorized participant and some bleed in the NAV that is a result of authorized participant connecting the two markets between the underlying securities and the ETF and making price impact on it and pulling it up. Meanwhile, as you can see here, P0 actually has not moved. P0 is the same. Intrinsic value is the same. Nothing has changed to P0. This is all uninformed liquidity, noise trading demand, which results in this very stylized picture, but it shows you that this mispricing or the difference between price and NAV is basically baked into the design of this asset. It's not something that's, good or bad or ugly, whatever you can call it. It's a feature of how this asset is designed. It is there, and it will change. It will respond with, depending on X and depending on parameter values reflecting costs. So that's a picture. I can pause for questions again.
Yes,
or I can
we
move
have
on to the dynamic model.
We have one question in the chat. Thomas Hart, do you want to take it in voice? Okay.
Hey, sure. Sorry, I was on mute.
Yeah, go ahead.
I think the terminology, I think the BlackRock speaker would know this better, but I think it's useful to distinguish between authorized participants as being primary market only. They may be market makers, but market makers are principally involved in the secondary market. In terms of players, the APs tend to be the banks, who are also market makers in the primary market, whereas in the secondary market, the Janes, Virtues, SIGs, players like that.
What's the question?
There is none. I'm just further to the.
It's a comment. So I'll show you who the authorized participants are. You are almost there. Actually, the most active, most prominent authorized participants are HFTs. So they're both in the primary market and in the secondary market. So banks are indeed present, and then there are some authorized participants who look more like traditional market makers, but there is heterogeneity there. HFTs are, to my surprise as well, are actually the most dominant.
Okay, so we will take two more questions in this break. It's first PK and then Yanbin.
Yeah, quick question again. So the levered ETFs, so what will be the, in your equation you're showing, so will it be linear, like 3x levered ETF? Will it be 3 times more overpriced or underpriced? Or is that more exponential relation there?
My guess it would be a curvature. Yeah, there would be a curvature.
Curvature, okay.
Yeah. Next question.
Okay, a very interesting paper. I just wondering the way you think about the inventory risk. Like, do you think the inventory risk at the aggregate level? Because I think the model is set at the ETF level, but if the AP is actually like being the multiple ETFs, then the underlying securities can be managed across different ETFs, right? So I'm wondering whether did you have like when you're talking about inventory risk, do you think about the inventory per ETF, or you thinking about the cross assets inventory, right? So for example, one ETF contains the same stocks, like two ETF contain the same stocks, but if for the AP try to manage the inventory, do you model that instead?
So I'll try to answer it with what I know from the empirical data. And so there is very clear heterogeneity in inventory management, and banks in particular look quite different from HFTs. So the way it looks like in terms of inventory management, and the picture I showed you before, which is an HFT by the way, is that HFTs are very good at managing their inventory, and they probably manage their inventory ETF by ETF. That's their kind of specialty. They know what they're doing. Whereas banks are probably more involved with clients. They're internalizing, they're doing other things. And so they may be looking at inventory management at the level of the sort of probably not the entirety of the balance sheet of their exposure, but maybe a part of that. So we will be looking at the actual, when we're taking this to data, we'll have to take care of that, which I'll show you what kind of we do. But this is the picture for you to think of where this comes from, right? And the idea here is that we have a model. We can show you kind of what this is. This model has limitations, and it is static. There's only one decision. It's perfect information. There's only one ETF investor. There's no information. There's no learning from order flow. There's no gains, and the model is kind of set up to be only costs. So our AP is only trying to make things less costly. So it's kind of like it's painful to manage this cost, but what are the gains? How can they gain from it that they're actually intermediating here? And gamma is also restricted to be between 0 and 1, so they only take a fraction. But in principle, gamma they could take directional position if they are actually engaged in sort of proper directional arbitrage. Why not? Right. So we're going to build for you a dynamic model, because actually that's not entirely what authorized participants actually do. And so the way to think about this gamma is to think of slope of the line. I'll tell you what the line is. So what you see here is 3 different APs, and they take positions monthly. We've calculated sort of average for the months their positions in the primary and the secondary market. And in the y-axis, you have their position in the primary market. And on the x-axis, you have their position average for the months, I believe, in the secondary market. So what that means is that if they create 100 shares, they're positive 100. And if they sell this 100 shares in the secondary market, they're negative 100. So they're going to be in the top left quadrant. And symmetrically, there will be the redeeming and they're buying sort of in the other quadrant. So the line should kind of cut like this. If it's exactly 45-degree line, their creation minus redemption and their activity in the secondary market are exactly aligned. They hold no position between the two, between the primary and the secondary market. They just shred through the market, right? And these are the top three APs in terms of sort of their activity. You can see that they're different. Some of them take enormous positions. Some of them are staying very, very close to zero. The slope of this line is also varies over. So we need some dynamics, and we also need some heterogeneity to basically cook into this model before we could take it to data. So here's what we're going to do. We are going to start with a Anand's model from 1993. Here's a beautiful market makers model, and we're going to add primary ETF arbitrage to it. We're going to have our market maker not just making markets, but also be able to create and redeem shares. So we're going to build on that. So we're going to have capital T periods. We're going to have three agents represented in this case. We're going to have one authorized participant, one informed trader, one noise trader. The fundamental value, the intrinsic value, what Anand said, is denoted by VT, and we're going to assume that it's a random walk. It just moves around as a random walk, right? And the ETF price and the net asset value are going to be projections of that VT as it moves about into the price surfaces of the two markets through the actual transactions and inventory management activity. So we are going to assume that there's a final traded gain undetermined, and which is going to hold some value. It's just for us to set up our dynamic problem. VT is private information, and it is observable by the informed trader. We can assume that the informed trader assumes a signal about VT with better precision, not going to change anything. We're just going to assume we're already going to be keeping a lot of error terms in there. We're just going to say that it actually knows exactly what VT is at the beginning of the period. They're uninformed agents. To them, VT is a random variable and nothing about it. It's just something that bops around as a random walk. And then final liquidation date is uncertain, and there is a chance probability of liquidation on each day, which will help us set up the Bellman's equation. Net demand for ETFs consists of two parts now. There is the part that is informed, there's a part that is uninformed, and the AP is actually going to extract information from this demand without knowing where the demand is necessarily coming from. And the AP is going to have some controls and some states. So in Anand's model, the states is the price we are going to also add the NAV and the inventory market and market order balance. Right. So we have two markets. We have inventory and price decisions in these markets, and everything here is going to move. The intrinsic value is moving as a random walk. This is important, right? So this showcases itself in the demand of informed and uninformed trader. There are prices here. There's net asset value. All of it is moving dynamically over time. And our AP is going to be managing inventory, just like our AP was doing in the static model. And the AP's wealth is going to consist of some capital that the AP holds to begin with. They're managing their inventory with some capital that evolves. They're also going to be hit with income from other investments. And here you can think again that, your banks that are managing sort of balance sheets and they have other things are going to be hit with probably more YT than proprietary high-frequency traders, or perhaps hit with less YT, right? So we're baking this into the model as well. And we're going to set it up as with costs as we had before. These costs are going to be function of volatility and feeding into the off of the wealth. There will be creation and redemption dynamics. PU is the NAV, is the price of the underlying. Again, similar linear market price impact equation. It is going to move around. And the objective is to maximize final period wealth. That's what they're maximizing, not knowing when it's going to happen. Which leads us to Bellman's equation, in which we have some states, some controls, which we can solve. Once we solve it, by substituting a particular type of a solution, it's an equilibrium, right? It's a particular linear type of equilibrium that we're going to solve for. Our P star, the price of the ETF that is set by the authorized participant, as you can see now, consists of multiple parts. Mu is the expected value, unconditional expected value of D, right? So that makes sense. Excuse me again. X is kind of like the X we had before, and alpha 2 is positive, kind of like what we had before. So this is, however, not actual noise demand, because the authorized participant doesn't know what the actual is, but what the authorized participant predicts by looking at the order flow, the actual part of it that is noise. And you also see two other terms. One of the terms is optimal inventory level given the information structure in this economy, and the deviation from this level. Because remember, information structure here matters. How much information moves around, how variable this underlying V is, would determine relative to sort of the signal that and what the informed trader does about it is going to matter in terms of how much inventory you actually have to hold. And then there will also be sort of deviation from between the NAV and the expected value of the underlying. So this also gives us gamma star. This also gives us equilibrium dynamics of the net asset value, and which leads us to the difference between the two. And as you can see here, we can give you a specification in which the pi prime in the period is has memory relative to pi. You know, it's an autoregressive process. It has memory with respect to x's and x primes, and it also moves with respect to information. So you can see here, it's going to move around zero, and it may have jumps related to both information and liquidity shocks, and inventory is going to be feeding into this. So there will be some persistence in this. So the way to think about it, I'm going to give you a picture.
Sorry, Andrei, I don't want to rush you, but
you need to rush.
Finish by the top of the hour.
In 5 minutes.
I thought
so
you
right.
had empirical results as well.
Right. Let me show you a picture. So this is the picture. So your ETF is the dog. Your net asset value is the dog owner. So the dog, a girl is taking a dog out on a random walk, and the dog could pull along the net asset value, and then that leash is the inventory management of authorized participant. If there is a lot of possibility of inventory management, the dog just runs off somewhere and the girl just keeps on walking. If they're on a short leash, the dog pulls the girl along. They have their own direction in which they're going. They're mostly on the random walk. They're just sort of walking around the park. But if you can think of an ETF pricing model, think of a dog on a leash. That's what it is. It's a dog, the ETF price, pulling the net asset value along. It can also go the other way around. The dog, the girl could pull the dog back, right? So the net asset value pulls the dog back if the dog gets too far, right? And the leash between them is, again, they're linked through the activity of the authorized participant. That's what links them between them. So with that, let's move to the data. We have daily data, a proprietary data with IDs from the MiFID II data set for 188 ETFs, 50 of which are equities, 78 of which are fixed income. They are mostly traded on LSE from 1st of January 2018 to the 21st of October 2020. Transaction time, price quantity, traded ID, trade types. We have 2 large ETF issuers. And we got from them creation redemption history for these ETFs for the same period. Trade date, APID, price and quantity of ETF shares transacted. We could merge now these 2 database, and they could create creation and redemption profiles. So this is what they look like, right? So you can see that there are actually names here that you can see. And you can see different participants. The one that I showed you before is Jane Street. So this is again for illustrative purposes only. You can see some high frequency traders, you can see some banks, you can see, but they're different. They sort of manage their inventory different. For some of them, this primary and secondary market is trending up. They're actually long in both of them. Some of them are fan charts. Some of them are more variable, some of them are less variable. So we will need to convert our model into a state space model, which is what we're going to do. It's a dog on a leash. So we have multiple moving parts. So we're going to have our inventory dynamic feeding, connecting the price of the ETFs and the net asset value. We do a bit of cleanup, and this is the final reduced form state space model in which YT is a vector of the price in the NAV. Alpha is the first element of the fundamental value, mu, the intrinsic value. And so these 2 things are projections, and how this alpha moves determines how these 2 projections move around. We need to take it to data. We'll need to cluster these participants, and what we're going to focus on in particular on high frequency traders. So high frequency traders here are going to be group 2 in green, and we're going to look at their inventory. So when we're putting inventory data into the structure model, we're going to put inventory of high frequency traders for the most active in this market by variety of metrics. Additional public data, and then we're going to take it to structural estimation. I'm omitting a lot of cleanup that we needed to do to keep things very tight from the market microstructure level, data generation process level, removing various outliers, keeping track of extracting information in the right way so that we can actually proxy for what is this unobserved informational and liquidity components are. That's what you see. So dependent variable is pi, so our price minus now. And you can see everything comes up as the way it is. We thought it would come up in our structural model. It shows up beautifully. We try to make it go away. It doesn't go away. It's there. It comes in the way we would think it would come in. You also see that mispricing for especially the memory for equity, the very last 4th column, is basically not there. There's a memory for fixed income is there in a large part. Again, not surprising. We can do it separately for ETF price and net asset value dynamics. We could do it for prices, NAV, and the results come out looking that we're onto something here. We've presented to you a model of how you can link the two prices, the ETF price and the net asset value, and actually price ETFs off of the intrinsic value underlying these two projections. Take it to a unique regulatory data set and find that it kind of holds together. Questions now, if there's any time.
Thank you very much, Andrei. Exciting paper. Before we go to the Q&A, let me announce that in 2 weeks, on October 14th, we have Alexander Ober from Rice University. So for those of you who have to leave now, welcome back in 2 weeks. Now, are there any questions for Andrei?
I have a question for Anans. Anans, what do you think? How does it hold together?
You put me on the spot. No, I think from my perspective, this is super interesting. The data is really unique. So I think the state space model is the way to go. So as I said, there are 3 variables, 3 values in ETF land. There's a market-driven price determined by supply and demand in the secondary market. There's a end-of-day NAV, which is done by some pricing provider using some secret sauce, and we don't know what that looks like. And then we have the intrinsic value, which is, as you correctly said, a reflection of which has information about both the price and the NAV, right? So, so I think some of the results that you got about fixed income and the persistence there make total sense, because sometimes those bonds trade weeks or months at a time. So that persistence is there. I'd say what's missing in this, which I think would be a great enhancement, would be to look at the flows and see, you know, how much of this mispricing is really actionable. So I come back to my first comment, which is, you know, you could see in March of 2020 for some of the fixed income ETFs, 5% plus or minus deviations from NAV. But you saw no flows because, you know, these smart hedge funds, the Citadels and others, couldn't actually trade on those prices. So I think that's the part that I think is really interesting, and the paper leads nicely into an exploration of that. So I'll stop there. But great paper. Thank you, Andrei.
Thank you so very much. Hey, invite me to come to Berkeley. I'll come. We'll hang out.
Absolutely. Be good to see you again.
PK.
Yeah, so I like that picture you just showed. And then I started thinking about the cryptocurrency. There are so many crypto ETFs approved now, and there is really no fundamental, right? So will that just the dog can run, and maybe that becomes the new NAV? What's
That's exactly right. So I mean that's so it is the dog and the owner are just out there. So they're both being bopped around whatever is happening around them, right? And
right.
they
like
are.
It's more related to fundamentals, but not in case of crypto, right? So is that a different equilibrium?
No, fundamentals here in the sense that, so remember, the fundamental here is around the wall, right? So fundamental here is you just go take a step to the left, step to the right. What makes crypto ETFs in particular very, very well sort of fit into this framework is that in our model, it is 1-for-1, right? And so Bitcoin ETF is actually 1-for-1. And as of recently, it is actually in kind. So that makes the fit of the actual modeling framework really quite compelling. And I hope we get to do some. FCA wants us to do some work on the crypto ETFs. In terms of where the dog and the owner are going, you know, they may have a plan when they go on this walk, but you know, the dog pulls on the owner decides to go and and get a cup of coffee. They're all over the place. So I mean, so in this case, V could be moving around in some way, just bops around by whatever it is, whatever it does it. Yeah. So does that make sense?
Yeah. And I don't know what kind of systematic risk that might lead to in future, but anyway, thank you. Yeah.
Systematic risk is the dog gets him, and starts, gets into a fight with another dog. Yeah.
Right.
Yep.
Hi, Andrei. Thanks for an interesting paper. I was trying to think through what this ETF mispricing means for welfare. And I guess before seeing this paper, sort of my naive thinking would have been that it harms investors. But now actually that I've seen it, I guess maybe it's the other way around. And I guess the way I was thinking about it, well, where does mispricing come from? Well, because these APs are taking on inventory. If they weren't taking on inventory, there wouldn't be any mispricing at all. But then if they weren't taking on inventory, then at least in the static model, I think the ETF investors would be getting worse prices. So actually, there's a sense in which investors benefit from this mispricing, at least in the static model. I'm not sure in the dynamic model. Does that sound like the right way to think about this? Does that resonate with you?
Yeah, to my great chagrin, I can't really call these authorized participants to be sort of predators, here. They make their money, they're baked into this, but they understand that they make their money to the extent that this show is going on. They don't want this to stop, they want this to work. My understanding is, and Anand, correct me, and as you can see by the sort of exponential rise of it, it's a big show. So it's an active, and investors like it. It's there's sort of something to it. I mean, certainly the original thinking about this being a kind of a redundant asset, or more of a sort of fiction story or something like that. I think that perhaps from the welfare perspective, we need to kind of rethink this a bit. But I agree with you.
Very interesting. Thanks.
Which, of course, it's a partial equilibrium model with a handful of moving parts. So there's nothing I can really say about welfare, except that the authorized participants are making pricing more informative through their activities. So they are transmitting information on liquidity shocks in a way, because of they're making money, but they're linking the markets in a way that kind of is informationally appropriate, to the extent that they are limited by how much inventory they can put on.
Okay, we have a question from Peter Lerner. Peter, do you want to take it in voice?
Can you read it for me, please?
Sure. Okay. So, Andrei, the number of ETFs is now larger than the number of traded stocks, which are their underlying. That means that the optimization of inventory for some authorized participants can be overdetermined. Can that be another reason for mispricing?
Right. So I'm not going to put an answer on the spot again, but this was part of the conversation that I had with him about kind of the secret sauce. How this ETF is actually designed, constructed, and what are they in response to? And maybe all it is basically creating securities with tracking errors to basically take advantage of unsuspecting market participants. It is there is certainly sort of feedback from price discovery vehicles into the underlying, and if you have multiple vehicles, probably one of them is going to be price discovery, and the other are probably going to follow in terms of price discovery. So there will be realignment there. And there will probably be compounding effect from those other vehicles. So the way I'm thinking about it, let's say there's a lead, S&P 500 ETF. And then there are 5 other S&P 500 ETFs. And then there's actually S&P 500. So lots and lots of activity in the S&P 500 ETF. Some of this activity feeds into the underlying and feeds into the other ETFs that also feed into the underlying. So there perhaps is a compounding effect there. Would I say things overshoot? Probably not, because there's only so much money on the table, and probably not. I think there's a possibility of a compounding effect. It's probably to some extent there. The economic, just guessing, not looking at it, just guessing that the actual economic significance of this additional compounding, of this additional curvature, I would be surprised if it's super large.
Thanks, Andrei. I don't see more questions at the moment. We have the added comment that Anant has a paper about what happens with more funds than stocks published. So you can look at that. If there are no more questions, it has been published in JOIM. I'm sure you will be able to find it, or Anant will send it to you.
It's in the Journal of Investment Management, and basically the idea is getting to Peter's question about, if there are more funds than stocks, what are all these funds doing, and is there an over redundancy? Can you use PCA to reduce the dimension of the fund space, and can you use the funds to price the stocks? So very related to his question.
Did what I say, did the way I answered it make sense to you, or am I right?
Yeah, absolutely. No, I think the market's becoming more efficient with all these ETFs. There's a lot of co-integration strategies, and some ETFs, obviously, like SPY, lead in price discovery. It's like a futures contract almost, and other ones like IGH and others lag. So,
but you will see in the first principle component that there are links to the first principle component, but then probably once you put the loadings on it, you will probably see that it's probably decline. So yeah, I'll need to see this paper. Yeah, thank you.
Right.
Thanks a lot, Andrei, for telling us about this project today. Thanks everyone for coming. I hope to see many of you again in 2 weeks.
Thank you so very much for having me. There's more to come.
Great.